Yeah, I think 2024 is likely to be dominated by rates heading lower and earnings growth accelerating. And that usually means you want to be pro-cyclical in your portfolio. So sectors like consumer discretionary and technology continuing to be leadership, but you also want to start to consider interest rate sensitives like real estate and like financials. So a couple of reasons. First, behind lower interest rates, we are in a pretty unique situation where inflation, especially the PCE deflator that the Federal Reserve watches, is now in the bottom quartile, below 2% on a 6-month basis, while nominal rates are in the top quartile. That's been a good situation historically for an increase in likelihood of Fed cuts. If interest rates are headed lower and earnings growth reaccelerates, and we're starting to see some leading indicators like labor costs coming down and input costs coming down, if that reaccelerates, we're transitioning from a situation in 2023 where earnings growth was contracting and rates were headed higher to the exact opposite situation. That dramatically improves your odds of outperformance in those interest rate sensitive sectors like financials and real estate. And that's not the only reason to consider them. One is that they've deeply lagged at the same time as valuation spreads are at top quartile levels. Remember, that's an expression of fear, and that's usually, if you are willing to look out over a 1-year time horizon, also provided alpha. You couple that with the fact that valuation is actually quite compelling in financials, which has usually led to increased odds of outperformance, and the fact that we're seeing bottom quartile fundamentals in real estate, you all of a sudden have a very skewed positive risk reward. So the pro-cyclical sectors like consumer discretionary and technology still look compelling to me in my work, but I think investors should start to consider more and more of those interest rate sensitives in real estate and financials.